And happy Friday to all of our options traders. Good morning, everyone. And another question I got from one of the traders in our group was, can an option trade below parity? And what had happened is that he had gotten near expiration and he said, well, I know that options, or at least I think they know, that they're not supposed to trade below intrinsic value. And yet I'm finding that these quotes, when I go to sell my option, that they are trading below intrinsic value or parity. So what's going on here? Well, it's a very good question, and so let's go find out more about it. Can an option trade below parity, and if so, under what conditions? Before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So first off, what is parity? Well, parity is just a condition. It's a fancy term that means that your option is behaving as if it's stock. It's equivalent to stock. And that will happen when it's trading for exactly intrinsic value, or at least very close, within a few pennies, which generally means it either has to be very deep in the money, or maybe has to be a little bit in the money, but right at expiration. So for example, let's say that you have the stock trading at 100 and you have the $80 call in your account and it's trading for 20. Well, this option is trading at parity. And what that means is that it only has the intrinsic value. We know that if the stock is 100, the $80 call must trade for at least 20 bucks. And if it's trading for more than that, it's because there is some time remaining. So we can tell that there's no time remaining. This option must be right at expiration. So it can't fall below 20, or at least that's what this person's question is. But we know at least that it should be trading for at least 20, and that would be trading at parity. And at that point, you'd be indifferent between owning the stock at 100 or paying $20 for the $80 call, because you could exercise the call, pay 80, and you've also spent 100 to control the shares. So that's how we find out if an option is trading at parity. We simply take the strike price, we add the current market value, and if it comes up to exactly the stock's price, or at least very close, then we know it's trading at parity. So what this person's question is, could this option be trading for less than this? Less than 20 bucks. So for example, could it be trading for $19? And we know that that would be trading below parity because we take the $80 strike plus the $19 market price, and that means you are effectively controlling the shares for 99 bucks. So you could either buy the stock for 100 or you could buy this call for 19, exercise it and pay 80, and somehow you've gotten a free dollar out of the deal. And so that's why people are going, well, this really couldn't happen. This option has to trade for at least 20. And so again, in this case, we would say this $80 call is trading below parity. That's more of a fancy way of saying it's trading below intrinsic value. It's trading below the value of the stock when we consider the exercise. So this person's question is, can an option trade below parity? Well, it's a good question because there are really two answers. Theoretically, no, it cannot happen. But what about practically? Yes, it can, but only under certain conditions. So for example, let's say that we have our $80 call trading for 19. So if this were actually happening in the market, and we have to assume that it is because, as you're going to find out, arbitrage is what's going to prevent this from happening. So you would really never see this in the market, but to show why, we have to assume that you can see it. So don't go out looking for opportunities like this to make free money. So let's just assume that it is sitting there in the market trading for 19. So what you would do in this case to capitalize on this is to short the stock, so you're going to get a $100 credit to your account. Now, of course, you owe 100 shares of stock. And so you would buy the $80 call, spend 19. Where do you get the $19 from? From the $100 credit right here. So that's one of the points about an arbitrage, is that you don't even need your own money. It's self-financing. The trade itself creates the money to execute it. So we short the stock, we collect 100, we take 19 of those dollars, we buy the $80 call. So on a net basis, we have an $81 credit sitting in our account. That's just the $100 minus 19. Now what's going to happen? First of all, If the stock is trading below 80, we're going to make more money. As you're going to find out, we actually have a synthetic put. For those of you who understand your synthetics, we are short stock and long a call. So we could cash out of it right now and pick up the free buck, but why not try to make more? It's not going to cost you anything. There's really no risk. That's what makes it an arbitrage. So we get to expiration, and if the stock is below our $80 call, we can make even more money. And so if the best scenario is for the stock to fall to zero, in which case we make the entire $81 credit. However, what if the stock is above 80 at expiration? So we're thinking, hey, we just shorted the stock at 100 and I've got to buy it back. It's gone up. I'm losing money here. Well, no, not really, because you can always exercise and pay 80. That's locked in. So if the stock is above 80, you exercise the call and now your maximum gain is $1. And that's because you have to take $80 from your net $81 credit, use that to exercise your call, you're going to spend the strike, and you're left with a buck. So you cannot lose. The worst case that can happen is you make $1, but you might as well hold through expiration hoping that the stock falls. So once you short the stock and buy this $80 call for a net credit of 81, this is your risk profile. Notice that the entire risk graph lies above zero. There's our minimum of $1. And you can also see that this risk graph looks like a put option because mathematically it is. It's a synthetic put. So once again, you could, as soon as you short the stock and buy that call, you could exercise it and capture the $1. But you might as well hold on. It's a free lottery ticket. You might as well hold it through expiration and see if you can gather more. And if not, worst case is you exercise the call and pay 80 and you're left with the buck. So what that should tell you is that this really should never be possible. It would be too good to be true because it's free money. And so here's what's actually going to correct it. It's the arbitrage. So we're assuming the $80 call is trading for 19. You short the stock, buy the $80 call for 19. What's happening to these prices? Well, as you and everybody else in the world figures this out, everybody is shorting the stock, and that's going to put downward pressure on its price. Everybody is also out there buying this call. That's going to put upward pressure on its price. And so what happens is that this difference starts to close in on itself. The arbitrage, the process of picking up this free money, is actually undoing the opportunity. So let's say that the prices move, maybe this falls to $99.90 and this rises to $19.10. What happens now? Well, it's still trading below parity. And we can tell because we can take the $80 strike plus the market price of $19.10, and that would be effectively $99.10 for the stock that's trading for $99.90. So it's actually 80 cents below parity. But it used to be trading for $1 below parity. It used to trade for 19 when we said it should have been trading for 20. So the arbitrage is starting to force this to get closer and closer to parity. But there's still free money to pick up, so what happens? People continue to short the stock. This price falls, they continue to buy the call. This price rises. What happens? The prices get closer. So now maybe the stock is trading for $99.60 and the call has risen to $19.40. And we find out it's still below parity. We can take the $80 strike plus the $19.40. It's trading effectively the stock for $99.40 when it's trading for $99.60. So you can effectively control the stock by buying the call for $19.40 and actually own the stock or control it for $99.40. Well, it's still 20 cents below parity. You might as well do it. Short sellers come in, continue to hammer the stock. They continue to buy the call. What happens? These numbers continue to get closer. And at some point, now they don't necessarily have to, let's say, lose 10 cents and gain 10 cents, but as long as you can see that these prices are going to converge, that you will eventually hit a level where maybe the stock is trading for $99.50 and the call is trading for $19.50. Now we take the $80 strike plus the $19.50. We find out effectively you're controlling shares for $99.50 and that is exactly where the stock is trading. So now we say the call is trading for parity. And again, another way to look at that is it's trading for only its intrinsic value. We have the $80 call with the stock at $99.50. There's $19.50 of intrinsic value, and that's exactly where it's trading. So if we had more time until expiration, this might be trading for 20 or 21 or 25, who knows? But it would not be below parity. And so that was really the question, is can it ever trade below parity? So what's happening graphically is that when the arbitrage first appeared, this was the risk graph that we could capture. We had this free dollar down here. But as arbitrageurs start shorting the stock and buying the call, this line, this black line, starts moving down. And once it hits here, where it's zero, the arbitrage is over and the free money game is done. So remember that this risk graph right here is at expiration. What would it look like prior to expiration when we do have extrinsic value? So prior to expiration, we've got our call option here in black, but you can see that there's a current curve in blue. And so we can see that we have some significant time on the option, and that's because there's a pretty good sized gap between the blue line, the current curve, and the black line at expiration. So at no point is this call option trading below parity. However, if we go super deep in the money, stock is going out this way. So yes, we might have 30 days to expiration. The very best we can do is to get it to trade at parity. And that's when that little gap between the blue and the black lines just starts closing super, super tight. Now it's going to really close in on the cost of carry, but it could still get very close to parity prior to expiration. But as time passes, this blue line starts to shrink towards the black, so maybe some time goes by, we're on this purple line. And look what happens. Now we have more possibilities to trade at parity. We can have the stock down here maybe at 107, and we're trading at parity, or maybe even closer to 106. But you can see that maybe at 105, there's still a pretty good gap. It's trading above parity. 104, there's a pretty good gap. But more time goes by, what happens? The purple line gets closer to the black. See, now 104 and 105 stock prices are trading at parity. But maybe 103 or so is not. 102 certainly is not. More time goes by, what happens? This gold line kind of moves down. Now 102 stock price is trading at parity. So it would be only right there at the monies that are not going to trade at parity. But as you get closer and closer to expiration, you can see that just about any stock price out here is going to push that option to trade at parity. And so let's say we get really close to expiration and that stock is trading for 110. The $90 call is trading for exactly 10, or at least that's what you're thinking. There's not much time. Maybe we're into the final 15 minutes of trading and you're saying, okay, it's got to be trading at parity. I should be able to sell this call for 10. Well, here's where you can find lots of cases where it will trade below parity. You might look at the bid and the ask and find that the bid is $9.95, 5 cents below parity, and the asking price might be $10.05. You're never going to see the asking price fall below parity, but you can on the bid. So what's happening here? Well, one way is to say if you don't want to hold this call, you don't want to exercise it or to go through auto exercise, you have to close it. Well, it's just trading at parity. There's nothing there to trade. So this little 5 cent, sometimes we call it throwing the market makers a bone. You're throwing them an extra 5 cents to just say, here's your tip, so to speak, for closing out this call. But you can't do that via extrinsic value because there is no extrinsic value. And that's why you can see the bid price sometimes fall below parity. However, if that happens, we've talked about this before, what could you do? Let's say if you had a sizable number of contracts, or maybe this bid is at $9.80. There's a pretty good discrepancy. What can you do? You can exercise and cover. And what you do here is you would short the stock. So you would collect $100. You're just going to do the arbitrage steps. You now owe 100 shares to the broker. That's what happens whenever you short shares. And you will now exercise your $90 call. You will spend $90. Where do you get the $90 from? From the $100 cash that you receive from the short sale. So again, it doesn't require any out-of-pocket expense. short the stock, exercise the call. When you exercise the call, you're buying 100 shares and you just happen to owe 100 shares. So these just cancel out. And you're just going to capture that $10 difference instead of having to sell the call for $9.95. But most of the time, you're going to find it's probably just not going to be worth it. But just keep that in mind. Should you see a case, sometimes with very high volatility stocks, that they can actually fall quite a bit below the intrinsic value or fall below parity. And this is a very simple way to fix it. So I hope that helps to answer the question. So can an option trade below parity? Theoretically, no, because of arbitrage. But in the real world, close to expiration, yeah, you can see them fall below parity on the bid, never on the offer. But if that happens and it's a big enough discrepancy, you can fix it with exercise and cover. So what I like about this is it really shows that if you understand options in the markets, you have so many more opportunities available to you than people who are just trying to either open it or close it. And when you have more choices, that's when you will have the most success. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.